financial chief market strategist, joining us now. And Kathryn, we'll talk about the Fed, but let's first start with the Bank of Japan. That was the big news out overnight, the negative interest rate, the zero interest rate era. It's officially over. What could that mean for global markets?
Well, it actually counterintuitively could mean a bit of an impetus for more growth in Japan. I think that negative interest rate policy was at best controversial in its effectiveness. So I think that's part of the reason why you continue to see this move higher in Japanese equities, which have done remarkably well. But look, if we're looking at, Katie, from a global perspective, of course, getting off of negative interest rate policy increases the attractiveness of the JGBs, which comes at a difficult time when you have a Fed unwinding its balance sheet and with very high financing needs. So I think that it increases the chances of a higher risk premia for U.S. Treasuries over the medium to long term.
Well, you bring up something that I've been wondering about. Of course, you think about some of the concerns of the past summer, all of this Treasury supply, and there not being necessarily enough buyers to absorb that. With higher JGB yields, is it possible that those Japanese buyers are just going to stay home, not bother with the U.S. Treasury market?
Right, or move out of the U.S. Treasury market and repatriate back into JGBs, I think also makes sense. Yeah, there's somewhat of a concerning dynamic here. I think there is the sponsorship, Katie, that is fundamental in nature from these current account surplus countries, such as China, such as Japan, such as Saudi Arabia, Russia. But the truth is, when you look at their holdings of treasuries, they are declining. So there's a diversification from treasuries into something such as gold, especially for China. I think that came after the sanctions on Russia. So there was this impression that if you're not in the friend zone of the U.S., then you are at risk. So we saw the big current account surplus countries start to diversify. So that also comes at a bad time. So I think the risk premium is de facto higher over the long term. The question is on the short term. And I think that the 2-year, the very short term treasuries, I think are attractive at current yields. We've seen a move higher, and I think that makes sense for 2024.
So short-term treasuries, they're attractive. Let's get your thoughts on equities, because the Bank of America Fund Manager Survey, it came out in the past 24 hours, and it was a pretty bullish read across the board, Kathryn. Just to read you some of the highlights here, you have global growth expectations at a 2-year high, risk appetite also at the highest since 2021. How do you stand versus consensus? When you think about your own risk appetite, how does that compare to the past couple years?
I'm certainly more cautious. I mean, when you look at that euphoria and that optimism, I think it hinges on core PCE services, ex-housing, that tick up that we saw in the last inflation prints being a one-off thing. If it's not a one-off thing, and we are in fact in a reflationary environment, then I think you're going to get a repricing of risk, Katie. So that's to be determined, but the market is taking it as a fact, which is that, of course, inflation is going to maintain its disinflationary trend that we saw in 2023. At the same time that the U.S. economy grows above potential, and that is not commensurate with trend 2% inflation. So either the Fed chooses an implicitly higher 3% target, or something's got to give here. So I think the euphoria is probably, or the optimism is probably well placed, but my position, Katie, is, and what I'm telling StoneX clients is to let's hedge our bets. Let's take out life insurance policies. Puts are remarkably cheap. Volatility is low. The VIX index is relatively low. So take out that protection. Take it out in the form of high yielding cash, which probably is going to stay high yielding because the Fed is unlikely to cut that dramatically this year, maybe 50 basis points. There's a chance that they don't cut at all. 2-year Treasury notes, gold, I think makes sense, especially if you look in the equity space in the defensive sectors that outperformed last year. But I wouldn't be chasing these high flyers that were the leaders over the past months.
Well, let's talk about that a little bit more, because also in this survey, the Magnificent Seven, long Magnificent Seven, that was the most crowded trade at about 58%. It sounds like you wouldn't necessarily be chasing some of those big tech names.
Well, if we're repricing, if the market is going to reprice a Fed that is not as dovish and as likely to cut as previously imagined, that's not good for tech. You know, that's not good, and I think it's not positive for any rate-sensitive sectors, especially if we consider that if the Fed maintains nominal rates at these very high levels for a prolonged period of time, that increases the risk of recession. So you have a double whammy here, and I think that chasing these top performers, the Mag 7, is probably not the place to be right now. I would be looking, if the market continues to move higher, which is a possibility under the soft landing scenario, I would be looking for equally weighted S&P 500, which year to date has done pretty well. We have seen a bit of a broadening out in the S&P. I think that's a good thing, a positive thing. But to get there, we would have to see a deceleration in economic growth. And really, we had one poor retail sales data. But I mean, I'm concerned about the strength of the labor market fomenting this core services, ex-housing inflation, which I think is a risk to markets.
All right, Kathryn, really enjoyed this conversation. Great preview, of course, as we count down to that Fed meeting in over 24 hours' time. Our thanks to Kathryn Rooney Vera, StoneX Financial Chief Market Strategist. Now, we want to shift gears here and talk about motorcycles, because the iconic Italian motorcycle brand Ducati announced